Question 1. The monitoring system demonstrates a consistent deviation from the insured's declared operational procedures for cargo handling, indicating a higher frequency of manual interventions and less adherence to pre-approved stowage plans. Which approach best reflects a professional risk assessment for this marine insurance policy? Option A. Review the monitoring system data in conjunction with the policy's risk appetite and engage with the insured to understand the reasons for the deviation and its impact on the risk profile before considering any policy adjustments. Option B. Disregard the monitoring system data as it represents a minor operational variance and does not fundamentally alter the nature of the insured cargo. Option C. Immediately adjust the premium upwards to reflect the perceived increase in risk due to the deviation from declared procedures. Option D. Rely solely on the historical claims data for this policyholder, as it has not indicated any issues to date. The correct answer is A. Review the monitoring system data in conjunction with the policy's risk appetite and engage with the insured to understand the reasons for the deviation and its impact on the risk profile before considering any policy adjustments. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the immediate need for accurate risk assessment with the potential for future changes in the insured's operational practices. Failure to adequately consider the implications of the monitoring system's data could lead to mispricing the risk, resulting in financial losses for the insurer or inadequate cover for the insured. Furthermore, it touches upon the insurer's duty of utmost good faith and the insured's duty to disclose material facts. The correct approach involves a thorough review of the monitoring system's data in conjunction with the existing policy terms and the insured's risk management procedures. This allows for a nuanced understanding of the actual operational risks being undertaken, rather than relying solely on historical data or assumptions. This approach aligns with the principles of prudent underwriting, ensuring that premiums accurately reflect the risk profile and that the policy provides appropriate cover. It also demonstrates a proactive commitment to understanding the insured's business, fostering a stronger client relationship, and potentially identifying opportunities for risk mitigation advice, which is a hallmark of professional conduct under the CII framework. An incorrect approach that relies solely on the historical claims data without considering the new operational insights from the monitoring system fails to adapt to evolving risk landscapes. This could lead to underpricing the risk if the new data indicates increased exposure, or overpricing if it suggests reduced risk, both of which are professionally unsound. It also risks breaching the duty of utmost good faith by not fully understanding the risk being insured. Another incorrect approach that involves immediately increasing the premium based on a preliminary, unverified interpretation of the monitoring data, without further investigation or consultation with the insured, is premature and potentially unfair. This could be seen as a punitive measure rather than a risk-based adjustment and may damage the client relationship. It also fails to uphold the principle of proportionality in premium setting. A further incorrect approach that ignores the monitoring system's data entirely, assuming the existing policy terms adequately cover the current operations, is negligent. This overlooks a significant source of information that could materially affect the risk assessment and the suitability of the existing cover. It demonstrates a lack of diligence and a failure to keep abreast of factors influencing the risk, which is contrary to professional standards. Professionals should adopt a systematic decision-making process. First, gather all relevant information, including new data sources like the monitoring system. Second, analyze this information critically, comparing it with existing policy details and risk assessments. Third, consult with relevant parties, including the insured, to clarify any ambiguities or concerns. Fourth, make a reasoned decision regarding policy terms, premiums, or risk mitigation strategies, ensuring it is compliant with regulatory requirements and ethical obligations. Question 2. Process analysis reveals that an insurance intermediary operating in the UK is considering expanding its marketing efforts for a new range of investment-linked insurance products. The intermediary is aware of the state-level insurance regulations governing product sales, but is uncertain about the extent to which federal or pan-UK financial regulations might also apply to the promotion of these products. Which approach best ensures compliance with the relevant regulatory framework? Option A. Rely on the advice of industry peers and historical practices, assuming that if state regulations are met, broader regulatory concerns are adequately addressed. Option B. primarily focus on adhering to all applicable state-level insurance department regulations, as insurance is predominantly a state-regulated industry in the UK. Option C. Seek guidance solely from the relevant state insurance regulator, assuming their oversight encompasses all aspects of insurance product marketing and sales. Option D. Conduct a comprehensive review of the Financial Services and Markets Act 2000 FSMA and relevant Financial Conduct Authority (FCA) handbook provisions concerning financial promotions and the regulation of investment products, alongside state-specific insurance laws. The correct answer is B. Primarily focus on adhering to all applicable state-level insurance department regulations, as insurance is predominantly a state-regulated industry in the UK. Explanation: this scenario presents a professional challenge because it requires an insurance intermediary to navigate the complexities of a dual regulatory environment, where both state and federal laws may apply to their operations. The challenge lies in accurately identifying which regulatory body has primary oversight for specific activities and ensuring compliance with all applicable rules, avoiding potential penalties and reputational damage. Careful judgment is required to distinguish between areas of exclusive state authority and those where federal oversight is paramount or concurrent. The correct approach involves a thorough understanding of the Financial Services and Markets Act 2000 FSMA and its interaction with specific state-level insurance regulations. Specifically, it requires recognizing that while insurance is largely regulated at the state level in the UK, certain activities, particularly those involving financial promotions or cross-border services, may fall under the purview of the Financial Conduct Authority (FCA), or other relevant UK regulatory bodies. The correct approach would be to consult the relevant sections of FSMA and any associated FCA handbook guidance that addresses the regulation of insurance intermediaries and their promotional activities, ensuring that all communications and business practices adhere to both the spirit and letter of these regulations. This proactive engagement with the applicable regulatory framework demonstrates professional diligence and a commitment to lawful operation. An incorrect approach would be to assume that all insurance intermediary activities are exclusively governed by state-level insurance departments, without considering potential federal or pan-UK regulatory overlays. This could lead to non-compliance with FCA rules regarding financial promotions, conduct of business, or authorization requirements, even if state-level requirements are met. Another incorrect approach would be to solely rely on outdated industry practices or informal advice without verifying current regulatory standing under FSMA and FCA rules. This failure to engage with the definitive regulatory framework would expose the intermediary to significant risk. Professionals should adopt a decision-making framework that prioritizes regulatory awareness and due diligence. This involves 1. Identifying the nature of the activity being undertaken, e.g., selling a specific insurance product, providing advice, marketing. 2. Determining the relevant regulatory jurisdictions, state, federal, pan-UK. 3. Consulting the primary legislation and regulatory guidance for each identified jurisdiction. 4. Seeking professional legal or compliance advice when in doubt. 5. Implementing robust internal compliance procedures to ensure ongoing adherence to all applicable regulations. Question 3. The evaluation methodology shows that a client has contacted your firm, expressing significant dissatisfaction with a financial product recommendation made by one of your advisors. The client alleges that the advisor failed to adequately explain the risks associated with the product, leading to substantial financial losses for the client. The client is now threatening legal action, citing negligence. As a compliance officer, what is the most appropriate initial course of action for the firm to take, considering the principles of tort law and regulatory expectations under the FCA framework? Option A. Offer the client a partial refund of fees paid to the firm as a gesture of goodwill, without admitting any wrongdoing or conducting a full investigation. Option B. Advise the client that the firm is not liable, as financial advice inherently carries risk, and suggest they consult their own legal counsel. Option C. Instruct the advisor to cease all communication with the client and await a formal legal claim before taking any action. Option D. Immediately initiate a thorough internal investigation into the advisor's conduct and the advice provided, while maintaining open communication with the client regarding the investigation process. The correct answer is D. Immediately initiate a thorough internal investigation into the advisor's conduct and the advice provided, while maintaining open communication with the client regarding the investigation process. Explanation. This scenario presents a professional challenge because it requires balancing the duty of care owed to clients with the potential for financial loss to the firm, all within the context of tort law principles. The advisor must navigate the complexities of negligence and strict liability to determine their firm's potential exposure and the appropriate course of action. Careful judgment is required to avoid both overreacting and underreacting to the situation, ensuring compliance with regulatory expectations and ethical obligations. The correct approach involves a thorough investigation into the facts, a clear understanding of the relevant tort law principles, and a proactive engagement with the client. This approach prioritizes transparency and client welfare, which are fundamental ethical and regulatory tenets. Specifically, it acknowledges the potential for negligence by the firm or its employees if a duty of care was breached, leading to foreseeable harm. It also considers strict liability, which might apply in certain product-related scenarios, though less common in advisory services themselves. By seeking to understand the client's perspective and the extent of their loss, the firm demonstrates its commitment to client satisfaction and its willingness to address potential wrongdoing. This aligns with the Financial Conduct Authority's (FCA) principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which mandate treating customers fairly and communicating clearly, honestly, and not misleadingly. An incorrect approach would be to dismiss the client's concerns without proper investigation. This fails to uphold the duty of care owed to the client and could be construed as a breach of contract or negligence. Ethically, it is unacceptable as it disregards the client's well-being and potential harm. From a regulatory standpoint, it violates the FCA's principles by not treating customers fairly and potentially misleading them about the firm's responsibilities. Another incorrect approach would be to immediately admit fault and offer compensation without a full understanding of the situation. While appearing proactive, this could expose the firm to unnecessary liability if no actual breach of duty occurred. It also bypasses the necessary due diligence required to assess the merits of the claim, potentially setting a precedent for future unsubstantiated claims, and failing to adhere to the principles of proportionality and fairness in dispute resolution. A further incorrect approach would be to solely focus on the firm's potential financial exposure and attempt to minimize it by delaying communication or withholding information from the client. This prioritizes the firm's interest over the client's and is a direct contravention of the FCA's Principle 6. It also risks reputational damage and regulatory sanctions for failing to act with integrity and transparency. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and record the client's complaint promptly. 2. Initiate an internal investigation to gather all relevant facts, including reviewing client files, communications, and internal procedures. 3. Assess the situation against relevant legal principles, including negligence, duty of care, breach, causation, damage, and any applicable strict liability provisions. 4. Consider the firm's professional indemnity insurance and notify the insurer if appropriate. 5. Communicate transparently and empathetically with the client, explaining the investigation process and potential outcomes. 6. Seek legal advice if the situation is complex or involves significant potential liability. 7. Aim for a fair and reasonable resolution, considering both the client's interests and the firm's obligations. Question 4. Strategic planning requires a professional services firm to consider its potential liabilities and the adequacy of its insurance cover. If a firm receives an email from a disgruntled former client outlining a series of alleged professional errors and stating their intention to seek legal advice regarding potential compensation, what is the most appropriate immediate course of action regarding the firm's professional liability insurance? Option A. Assume the alleged errors fall outside the policy's coverage and take no immediate action regarding insurance. Option B. Inform the professional liability insurer immediately about the circumstances and the potential claim. Option C. Attempt to resolve the matter directly with the former client to avoid involving the insurer. Option D. Wait to notify the insurer until a formal legal document such as a writ or summons is received. The correct answer is B. Inform the professional liability insurer immediately about the circumstances and the potential claim. Explanation. This scenario is professionally challenging because it requires a firm to balance its commercial interests with its legal and ethical obligations to clients, particularly when dealing with potential liability claims. The firm must navigate the complexities of professional liability insurance, understanding its scope, limitation, and the reporting requirements to avoid policy breaches. Careful judgment is required to ensure that all relevant parties are informed appropriately and that the firm acts with integrity and in compliance with regulatory expectations. The correct approach involves proactively informing the insurer about the potential claim as soon as the firm becomes aware of circumstances that could give rise to a claim. This aligns with the duty of utmost good faith owed to the insurer and is a standard condition in most professional liability insurance policies. Prompt notification allows the insurer to investigate the matter, assess its potential liability, and manage the claim effectively, which is a regulatory expectation for insurers and policyholders alike under the Financial Conduct Authority's (FCA) Principles for Businesses, specifically Principle 7, Communications with Clients, and Principle 8, Claims Handling. It also prevents the firm from being accused of late notification, which could prejudice the insurer's position and potentially invalidate cover. An incorrect approach would be to delay informing the insurer until a formal writ or summons is served. This failure to notify promptly breaches the policy terms and the duty of utmost good faith. It deprives the insurer of the opportunity to investigate and defend the claim at an early stage, potentially increasing the costs and complexity of the claim, and could lead to the insurer repudiating liability. This also contravenes regulatory expectations regarding fair treatment of customers and efficient claims handling. Another incorrect approach would be to attempt to settle the claim directly with the client without involving the insurer. This bypasses the insurer's contractual right to manage claims and could expose the firm to financial loss if the settlement amount exceeds what the insurer would have agreed to or if the claim is ultimately found to be invalid. It also fails to comply with the policy's requirement for insurer consent before admitting liability or settling a claim, and it disregards the regulatory framework governing insurance claims handling and the insurer's role. A further incorrect approach would be to assume the claim falls outside the policy's scope without consulting the policy wording and the insurer. While policies have exclusions, a premature assumption can lead to a loss of cover if the claim, in fact, is covered. The professional duty requires a thorough review of the policy, and if necessary, seeking clarification from the insurer before making such a determination. This demonstrates a lack of due diligence and a failure to uphold the firm's responsibilities under the insurance contract and regulatory guidance on fair claims handling. The professional decision-making process for similar situations should involve 1. Immediately identifying any event, circumstance, or potential claim that could trigger a liability insurance policy. 2. Reviewing the relevant insurance policy wording, paying close attention to notification clauses, exclusions, and conditions. 3. Consulting with the firm's compliance officer or legal counsel to assess the situation and understand the firm's obligations. 4. Promptly notifying the insurer of any potential claim or circumstances that could give rise to a claim, providing all relevant details. 5. Cooperating fully with the insurer throughout the claims process. 6. Maintaining clear and accurate records of all communications and actions taken. Question 5. Operational review demonstrates that a financial services firm is planning to implement a new customer onboarding system designed to significantly reduce processing times. The project team is eager to launch the system as quickly as possible to realize the efficiency benefits. Which of the following approaches best aligns with the firm's regulatory obligations for risk management? Option A. Implement the new system and its associated controls. Defer the establishment of a formal monitoring framework until the system has been operational for a defined period. Option B. Proceed with the system launch immediately to capture efficiency gains and address any identified risks post-implementation. Option C. Prioritize the implementation of the new system based on its potential for cost savings and only consider risk management if a specific issue arises. Option D. Conduct a thorough risk assessment of the new system, identify potential risks, implement controls, and establish a monitoring plan before the system goes live. The correct answer is B. Proceed with the system launch immediately to capture efficiency gains and address any identified risks post-implementation. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the firm to balance the immediate need for operational efficiency with its ongoing regulatory obligations for risk management. The pressure to implement changes quickly can lead to overlooking critical steps in the risk management process, potentially exposing the firm to significant compliance breaches and financial penalties. Careful judgment is required to ensure that the drive for efficiency does not compromise the integrity of risk controls. Correct approach analysis. The correct approach involves a systematic and integrated application of the risk management process. This means that before implementing any new operational procedures, the firm must first identify potential risks associated with these changes, assess their likelihood and impact, implement appropriate controls to mitigate these risks, and establish a monitoring framework to ensure the controls remain effective. This aligns with the principles of robust risk management expected under UK financial services regulation, which mandates a proactive and comprehensive approach to identifying, assessing, and mitigating risks to protect consumers and market integrity. The Financial Conduct Authority (FCA) Handbook, particularly in SISC systems and controls, emphasizes the need for firms to have adequate systems and controls in place to manage risks effectively. Incorrect approaches analysis. Implementing new operational procedures without a prior risk assessment fails to identify potential vulnerabilities that could lead to regulatory breaches or financial losses. This bypasses the crucial identification and assessment stages of the risk management process, creating an environment where risks are managed reactively rather than proactively. This is a direct contravention of the FCA's expectations for sound risk management, focusing solely on the efficiency gains of the new procedures while neglecting the associated risks, demonstrates a failure to embed risk management into the firm's operational decision-making. This prioritizes short-term benefits over long-term stability and compliance, which is ethically unsound and regulatorily unacceptable. It suggests a culture where risk is an afterthought rather than an integral part of business operations. Establishing controls for the new procedures but failing to implement a monitoring mechanism means that the effectiveness of these controls is never verified. Risks can evolve, and controls can become outdated or ineffective. Without monitoring, the firm cannot assure itself or the regulator that risks remain adequately managed, leaving it exposed to potential future failures. This neglects the continuous nature of effective risk management, as required by regulatory frameworks. Professional reasoning. Professionals should adopt a decision-making framework that integrates risk management into every stage of operational change. This involves 1. Understanding the regulatory expectations for risk management within the relevant jurisdiction, e.g., FCA Handbook for UK firms. 2. Adopting a structured risk management process. Identify, assess, control, monitor. 3. Ensuring that each step of the process is completed thoroughly before proceeding to the next. 4. Documenting the risk management activities undertaken. 5. Seeking appropriate expertise or guidance when dealing with complex risks. 6. Prioritizing compliance and consumer protection alongside business objectives. Question 6. The audit findings indicate that an underwriter at a UK-based general insurance company has classified a potential future flood event in a coastal property as a certainty rather than a risk when assessing a new policy application. The underwriter's rationale is that the property is located in an area known to be susceptible to flooding. Which of the following best describes the underwriter's classification in relation to the definition of risk within the UK regulatory framework? Option A. The underwriter has correctly identified a past event that has already occurred. Option B. The underwriter has correctly identified a certainty which is not insurable as a risk. Option C. The underwriter has correctly identified a risk that needs to be priced into the policy. Option D. The underwriter has incorrectly classified a potential future event as a certainty, failing to recognize it as a risk. The correct answer is C. The underwriter has correctly identified a risk that needs to be priced into the policy. Explanation. This scenario presents a professional challenge because it requires the underwriter to distinguish between a potential future event that could cause financial loss risk and a certainty or a past event. Misclassifying these can lead to incorrect pricing, inadequate reserves, and ultimately, regulatory breaches and financial instability for the insurer. Careful judgment is required to apply the definition of risk as understood within the UK regulatory framework for insurance. The correct approach involves identifying that the potential for a flood to damage property is a future, uncertain event that could result in a financial loss for the insurer. This aligns with the fundamental definition of risk in insurance, which is the possibility of an adverse deviation from an expected outcome. Financial Conduct Authority, FCA Handbook, particularly in sections related to prudential regulation and risk management, emphasizes the need for firms to identify, assess, and manage risks. In this context, the possibility of a flood is a quantifiable risk that needs to be priced into the policy. An incorrect approach would be to consider the flood as a certainty or a past event. If the flood has already occurred, it is no longer a risk but a claim. If the area is guaranteed to flood, it moves from an uncertain event to a certainty, which is generally uninsurable in the traditional sense, as it removes the element of chance. Treating a certainty as a risk would lead to mispricing and potentially unsustainable underwriting. Another incorrect approach would be to dismiss the possibility of a flood entirely because it has not happened recently. This fails to acknowledge the inherent uncertainty and potential for future events that are central to the concept of risk in insurance. Such an oversight would violate the FCA's expectations for robust risk assessment and management, potentially leading to under-reserving and inadequate capitalization. Professionals should approach such situations by first clearly defining the event in question. Is it a past event, a future certainty, or a future uncertainty? If it is a future uncertainty that could lead to financial loss, it is a risk. The next step is to assess the likelihood and impact of this uncertain event. This involves using historical data, actuarial models, and expert judgment to quantify the potential financial consequences. Finally, the insurer must decide whether to accept, mitigate, transfer, or avoid this risk, ensuring that its pricing and capital adequacy reflect the identified risk profile. This systematic process ensures compliance with regulatory expectations for sound risk management. Question 7. Quality control measures reveal that a new insurance advisor who has applied for authorization but is awaiting final approval from the Financial Conduct Authority, FCA, is being asked by a client to provide specific advice on selecting a suitable life insurance policy. The firm's compliance department is aware of the advisor's pending application. What is the most appropriate course of action for the firm to take in this situation? Option A. Advise the client that the new advisor can provide advice once their application has been processed, and offer to have a different, fully authorized advisor handle the request in the interim. Option B. Decline to allow the new advisor to provide any advice on the insurance policy until their FCA authorization is formally granted. Option C. Permit the new advisor to provide general information about different types of life insurance policies, but not specific recommendations. Option D. Allow the new advisor to provide the advice, with a senior advisor present to supervise, as the authorization process is underway. The correct answer is D. Allow the new advisor to provide the advice, with a senior advisor present to supervise, as the authorization process is underway. Explanation. This scenario presents a professional challenge because it requires an insurance intermediary to navigate the complexities of regulatory licensing requirements while ensuring client needs are met. The challenge lies in balancing the urgency of a client's request with the absolute necessity of adhering to legal and regulatory frameworks governing who can provide regulated financial advice. A failure to do so can result in significant penalties for both the individual and the firm, as well as potential harm to the client. The correct approach involves recognizing that providing regulated advice without the appropriate authorization is a breach of the Financial Services and Markets Act 2000, FSMA, and the FCA's Conduct of Business Sourcebook, COBS. Specifically, the FCA Handbook outlines the stringent requirements for firms and individuals to be authorized to carry out regulated activities, which includes advising on insurance products. Therefore, the intermediary must decline to provide the advice until the new advisor has obtained the necessary authorization. This upholds the regulatory integrity of the financial services industry, protects consumers from unqualified advice, and ensures the firm operates within legal boundaries. The FCA's principles for businesses, particularly Principle 2, Skill, Care and Diligence, and Principle 3, Management and Control, mandate that firms ensure their staff are competent and that appropriate controls are in place to prevent regulatory breaches. An incorrect approach would be to allow the new advisor to proceed with providing advice, even under supervision, without the requisite authorization. This directly contravenes FSMA and COBS, as it constitutes carrying out a regulated activity without authorization. It also fails to uphold the FCA's principles, particularly Principle 2, by exposing the client to potentially unqualified advice. Furthermore, it demonstrates a lack of adequate management and control, violating Principle 3, as the firm would be failing to prevent a regulatory breach. Another incorrect approach would be to interpret the request as a minor administrative matter and proceed with the advice provision while the authorization process is underway. This ignores the strict legal definition of regulated activities and the requirement for authorization before such activities commence. The FCA's regulatory framework does not permit a grace period for individuals undertaking regulated activities without authorization, regardless of the stage of their application. This approach also risks misleading the client about the advisor's current regulatory standing. Finally, an incorrect approach would be to suggest that the new advisor could provide general information about insurance products, but not specific advice. While there is a distinction between general information and regulated advice, the line can be easily blurred, especially in a client-facing situation. Without clear guidance and strict adherence to the FCA's definitions, this approach could still inadvertently lead to the provision of regulated advice without authorization, creating a significant compliance risk. The regulatory framework demands clarity and certainty regarding authorization for regulated activities. Professionals should employ a decision-making framework that prioritizes regulatory compliance and client protection. This involves 1. Identifying the nature of the request. Is it a regulated activity? 2. Verifying the regulatory status of the individual involved. Do they hold the necessary authorization? 3. Consulting relevant regulatory guidance and internal compliance policies. 4. If there is any doubt or a potential breach, err on the side of caution and decline the activity until full compliance is achieved. 5. Documenting the decision-making process and any advice sought from compliance or legal departments. Question 8. The control framework reveals that a financial advisor is assisting a client who is interested in an investment product linked to a nascent technology with unpredictable future adoption rates. The advisor has conducted initial research, but acknowledges significant unknowns regarding the technology's long-term viability and market acceptance. Which of the following represents the most appropriate course of action for the advisor, considering regulatory obligations and ethical considerations? Option A. Recommend the investment product, highlighting its potential for substantial growth while downplaying the speculative nature of the underlying technology to encourage the client's investment. Option B. Conduct further in-depth research into the emerging technology's potential impacts, clearly communicate the range of possible outcomes and associated risks to the client, and ensure the investment is suitable for the client's specific circumstances and risk tolerance. Option C. Rely solely on the product provider's prospectus and marketing materials to explain the investment to the client, assuming these documents adequately cover all potential risks. Option D. Advise the client against investing in the product due to the inherent uncertainties, even if the client's risk profile might otherwise accommodate such an investment. The correct answer is A. Recommend the investment product, highlighting its potential for substantial growth while downplaying the speculative nature of the underlying technology to encourage the client's investment. Explanation. The control framework reveals a scenario where a financial advisor is presented with a client seeking advice on an investment product whose long-term performance is highly uncertain due to emerging technological disruption. This situation is professionally challenging because the advisor must balance the client's potential for high returns with the significant risk of capital loss, all while adhering to regulatory obligations regarding suitability and disclosure. The inherent uncertainty necessitates a robust and transparent approach to client communication and product recommendation. The correct approach involves thoroughly researching the emerging technology, understanding its potential impact on the investment product, and clearly communicating the associated uncertainties and risks to the client. This includes explaining the range of possible outcomes, both positive and negative, and ensuring the client fully comprehends the speculative nature of the investment. This aligns with the Financial Conduct Authority's FCA principles, particularly Principle 7, Communications with Clients, and Principle 9, Skill, Care, and Diligence, which mandate that firms act honestly, fairly, and professionally in accordance with the best interests of their clients. It also reflects the FCA's focus on ensuring consumers receive suitable advice, especially in complex or uncertain product areas. An incorrect approach would be to downplay the uncertainties and focus solely on the potential upside, perhaps due to pressure to meet sales targets or a lack of thorough due diligence. This would violate the FCA's principles by failing to act in the client's best interests and by providing misleading information. Another incorrect approach would be to avoid recommending the product altogether due to the uncertainty, even if it genuinely aligns with the client's risk appetite and objectives. This could be seen as failing to provide appropriate advice and potentially limiting the client's investment opportunities without sufficient justification, also contravening the duty to act in the client's best interests. A third incorrect approach would be to rely solely on the product provider's marketing materials without independent verification of the risks associated with the underlying technology, which would demonstrate a lack of due diligence and potentially lead to unsuitable advice. Professionals should adopt a decision-making framework that prioritizes client understanding and regulatory compliance. This involves a systematic process of risk assessment, thorough research, clear and transparent communication of all material facts and uncertainties, and a robust suitability assessment that considers the client's individual circumstances, knowledge, and attitude to risk. The advisor must be able to articulate the rationale behind any recommendation, demonstrating that it is in the client's best interests, even in the face of significant uncertainty. Question 9. The risk matrix shows a small manufacturing firm in the UK faces significant potential liabilities related to employee injuries and risks of internal fraud. As an insurance intermediary, which approach best ensures regulatory compliance and ethical client service regarding workers' compensation and crime insurance. Option A. Advise on a comprehensive workers' compensation policy tailored to the firm's specific manufacturing processes and a crime insurance policy that addresses identified vulnerabilities to internal fraud, cyber threats, and theft, with clear explanations of policy terms and exclusions. Option B. Offer the most cost-effective workers' compensation policy available and a basic crime policy, focusing on immediate premium savings for the client. Option C. Recommend a standard employer's liability policy that meets the minimum statutory cover and a broad-form crime policy, ensuring the client understands the compulsory nature of employer's liability and the general scope of crime cover. Option D. Suggest a package policy that includes general liability and property damage, with workers' compensation and crime insurance as optional add-ons, allowing the client to choose the level of protection. The correct answer is C. Recommend a standard employer's liability policy that meets the minimum statutory cover and a broad-form crime policy, ensuring the client understands the compulsory nature of employer's liability and the general scope of crime cover. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance intermediary to navigate the complexities of regulatory compliance in the context of casualty insurance, specifically workers' compensation and crime insurance, while also considering the ethical implications of their advice. The intermediary must ensure that the proposed insurance solutions not only meet the client's perceived needs, but also adhere strictly to the legal and regulatory framework governing these types of insurance in the UK, as per the CII exam's jurisdiction. Misinterpreting or overlooking regulatory requirements can lead to significant financial penalties, reputational damage, and harm to the client. Correct approach analysis. The correct approach involves the intermediary conducting a thorough needs analysis that explicitly considers the client's specific business operations, potential liabilities under the relevant UK legislation, e.g., the Employer's Liability Compulsory Insurance Act 1969 for workers' compensation, and the risks associated with criminal acts as defined by UK law. This includes advising on the appropriate level of cover, policy wording, and ensuring compliance with the Financial Conduct Authority's (FCA) conduct of business rules, particularly those relating to suitability and disclosure. The intermediary must also ensure the client understands the scope and limitations of the proposed policies, especially regarding exclusions in crime insurance and the compulsory nature of employers' liability insurance. This aligns with the FCA's principles for businesses, specifically Principle 6, Customers' Interests, and Principle 7, Communications with Clients, and the Insurance Distribution Directive (IDE), Requirements for Fair Advice and Product Governance. Incorrect approaches analysis. an approach that focuses solely on offering the cheapest available workers' compensation policy without a detailed assessment of the client's workforce size, nature of work, and potential claims history would be incorrect. This fails to meet the compulsory insurance requirements of the Employer's Liability, Compulsory Insurance, Act 1969, and the FCA's suitability obligations, potentially leaving the client uninsured for statutory liabilities. An approach that suggests a generic crime insurance policy without understanding the client's specific vulnerabilities to fraud, theft, or cyber attacks would also be incorrect. This overlooks the need for tailored advice and product governance under the IDD, potentially resulting in inadequate cover for the client's actual risks. An approach that prioritizes upselling additional, non-essential insurance products over ensuring the fundamental legal and regulatory requirements for workers' compensation and core crime risks are met would be ethically and regulatorily unsound. This contravenes the FCA's focus on customer best interests and fair treatment. Professional reasoning. Professionals should adopt a client-centric, risk-based approach. This involves 1. Understanding the client's business and identifying all relevant insurable risks, with a particular focus on statutory obligations like employer's liability. 2. Researching and understanding the specific regulatory requirements for each type of insurance being considered, e.g., employer's liability, compulsory insurance, Act 1969, FCA Handbook. 3. Conducting a detailed needs analysis to determine the appropriate scope, level of cover, and policy terms for both workers' compensation and crime insurance, considering the client's specific circumstances and potential exposures. 4. Clearly communicating the features, benefits, limitations, and exclusions of proposed policies to the client, ensuring they understand their responsibilities and the extent of the cover. 5. Documenting the advice provided and the rationale behind the recommendations, demonstrating compliance with regulatory requirements and ethical duties. Question 10. The monitoring system demonstrates that a prospective client has submitted an application for a life insurance policy, providing details about their health and lifestyle. However, several key questions regarding their medical history and recent travel have been left unanswered. The underwriting team is considering proceeding with issuing a policy based on the information available, assuming the missing details are unlikely to be material. Which of the following represents the most appropriate course of action to ensure the formation of a valid contract? Option A. Contact the prospective client to request the outstanding information and explain that a contract cannot be finalized until all material facts are disclosed and agreed upon. Option B. Issue the policy with a note that it is subject to the applicant providing the missing information within a specified time frame, without further explanation. Option C. Reject the application immediately due to the incomplete information, without offering the applicant a chance to provide further details. Option D. Proceed with issuing the policy as is, assuming the unanswered questions are not material to the risk. The correct answer is A. Contact the prospective client to request the outstanding information and explain that a contract cannot be finalized until all material facts are disclosed and agreed upon. Explanation. The scenario presents a common challenge in insurance underwriting where a potential policyholder provides incomplete information. The professional challenge lies in balancing the need to gather all necessary information to form a valid contract with the risk of alienating a potential client or misrepresenting the insurer's position. Careful judgment is required to ensure that the insurer's actions do not inadvertently create a contract or mislead the applicant. The correct approach involves clearly communicating the need for further information and explaining that a contract cannot be formed until all material facts are disclosed and agreed upon. This aligns with the fundamental principle of utmost good faith, uberrimi fidei, in insurance contracts, which requires both parties to disclose all material facts. Specifically, the insurer must ensure there is a clear offer and acceptance based on complete information. Without full disclosure, the acceptance may be conditional or invalid, and the consideration may not be properly established. This approach upholds regulatory requirements for fair dealing and transparency, preventing the formation of a contract based on incomplete or potentially misleading information. An incorrect approach would be to proceed with issuing a policy based on the limited information provided, assuming the missing details are not material. This fails to uphold the principle of utmost good faith and risks creating a contract that is voidable by the insurer if material non-disclosure is later discovered. It also bypasses the essential element of offer and acceptance, as the insurer has not fully evaluated the risk being offered. Another incorrect approach would be to reject the application outright without explaining the reasons, or offering the applicant an opportunity to provide the missing information. This could be seen as unfair dealing and may not align with the insurer's obligations to act with reasonable care and skill. While not directly a breach of contract formation principles, it can lead to reputational damage and potential regulatory scrutiny for poor customer service. A further incorrect approach would be to issue a policy with significant exclusions or caveats that were not clearly communicated or understood by the applicant at the outset. This undermines the element of acceptance, as the applicant may not have truly agreed to the terms presented. It also fails to ensure clarity in the offer and acceptance, which are cornerstones of a valid contract. The professional decision-making process for similar situations should involve 1. Identifying the missing information and its potential materiality to the risk. 2. Communicating clearly and promptly with the applicant to request the necessary details. 3. Explaining that a contract cannot be finalized until all material facts are disclosed and accepted. 4. Documenting all communications and decisions. 5. Ensuring that any policy issued accurately reflects the agreed-upon terms and conditions based on full disclosure. Question 11. What factors determine the primary beneficiaries of an insurance company's profits and the governance mechanisms in place, considering the distinct ownership structures of stock, mutual, and reciprocal insurers? Option A. The geographical location of the insurer's headquarters and the number of independent directors on its board. Option B. The marketing strategies employed by the insurer and the perceived reputation of its senior management team. Option C. The size of the insurance company's asset base and the prevailing market interest rates. Option D. The ownership structure of the insurer, stockholder-owned, policyholder-owned mutual, or reciprocal exchange, and the associated legal and regulatory frameworks governing profit distribution and governance. The correct answer is D. The ownership structure of the insurer, stockholder-owned, policyholder-owned mutual, or reciprocal exchange, and the associated legal and regulatory frameworks governing profit distribution and governance. Explanation. This scenario is professionally challenging because it requires an understanding of how different ownership structures of insurance companies impact their governance and the distribution of profits, which directly affects policyholder interests and regulatory compliance. The choice of ownership structure has profound implications for how decisions are made, who benefits from the company's success, and the company's overall financial stability. Careful judgment is required to assess these implications from a stakeholder perspective, particularly concerning policyholders, shareholders, and regulators. The correct approach involves considering the fundamental differences in how stock, mutual, and reciprocal insurers are owned and operated, and how these differences align with the interests of their respective stakeholders. Stock insurers are owned by shareholders, and profits are distributed to them. Mutual insurers are owned by their policyholders, who can receive dividends or benefit from lower premiums. Reciprocal insurers are owned by their policyholders, who also act as insurers for each other. Understanding these distinctions is crucial for determining how factors like profit distribution, governance, and risk management are approached within each structure, and how these align with regulatory expectations for fair treatment of all stakeholders. An incorrect approach would be to assume that all insurance companies operate under the same profit distribution model, regardless of their ownership structure. This fails to recognize the core principle of mutual and reciprocal insurance, where policyholders are the owners and therefore the primary beneficiaries of the company's success. Another incorrect approach is to focus solely on shareholder returns when evaluating a stock insurer, neglecting the regulatory duty to maintain solvency and treat all policyholders fairly. Similarly, an incorrect approach would be to overlook the potential for conflicts of interest in reciprocal exchanges, where policyholders are both insurers and insured, and to not consider the regulatory oversight required to manage these. Professionals should adopt a decision-making framework that begins with identifying the specific ownership structure of the insurer. They must then analyze the implications of this structure for stakeholder interests, particularly policyholders, and consider the relevant regulatory requirements governing that structure. This involves understanding the legal and ethical obligations associated with each type of insurer, ensuring that decisions made are in the best interests of the intended stakeholders, and comply with all applicable laws and guidelines. Question 12. Examination of the data shows that a new insurance product is being developed with innovative features aimed at enhancing customer benefits. To ensure compliance and consumer protection, which UK regulatory agency holds the primary responsibility for overseeing the conduct of firms in relation to the design, marketing, and sale of such products? Option A, HM Treasury. Option B, the Financial Ombudsman Service, FOS. Option C, the Prudential Regulation Authority, PRA. Option D, the Financial Conduct Authority, FCA. Correct answer is D, the Financial Conduct Authority, FCA. Explanation. This scenario is professionally challenging because it requires an understanding of the distinct roles and responsibilities of key regulatory agencies within the UK insurance market, specifically the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA. Misinterpreting these roles can lead to incorrect assumptions about regulatory oversight and enforcement, potentially impacting a firm's compliance strategy and risk management. The correct approach involves accurately identifying the primary regulator responsible for consumer protection and market conduct within the insurance sector. This is the FCA, which has a broad remit to ensure that markets function well and that consumers receive a fair deal. The FCA's focus is on the conduct of firms, the integrity of financial markets, and the protection of consumers. Therefore, understanding the FCA's role in setting standards for product design, sales practices, and claims handling is crucial. An incorrect approach would be to solely focus on the PRA's responsibilities. The PRA is primarily concerned with the prudential regulation of banks, building societies, credit unions, insurers, and major investment firms. Its focus is on the safety and soundness of these firms, ensuring they have adequate capital and risk management systems to protect policyholders from insolvency. While the PRA's work indirectly benefits consumers by ensuring firm stability, it is not the primary regulator for day-to-day conduct and consumer protection issues. Attributing consumer protection responsibilities solely to the PRA would be a significant regulatory failure. Another incorrect approach would be to assume that a single agency, such as the Financial Ombudsman Service, FOS, is the primary regulatory body for all aspects of insurance. The FOS is an independent body that resolves disputes between consumers and financial services firms. While it plays a vital role in consumer redress, it is an ombudsman service, not a primary regulator setting conduct rules or supervising firms' overall compliance. Relying on the FOS as the primary regulatory agency for proactive oversight would be a misunderstanding of its function and a failure to engage with the core regulatory framework. Finally, an incorrect approach would be to overlook the role of HM Treasury. HM Treasury is responsible for the overall economic policy of the UK and plays a role in developing the legislative framework for financial services regulation. However, it does not directly regulate firms or enforce conduct rules. Focusing on HM Treasury as the primary operational regulator for insurance firms would be a misapplication of its policy-setting function. Professional decision-making in such situations requires a clear understanding of the division of regulatory responsibilities. Professionals must identify the specific regulatory agency whose remit aligns with the issue at hand. This involves consulting official regulatory guidance, understanding the statutory objectives of each body, and recognizing the distinct areas of focus for prudential versus conduct regulation. When in doubt, seeking clarification from compliance departments or directly from the relevant regulatory bodies is essential. Question 13. When evaluating a potential insurance sale to a new client who expresses a strong preference for a specific, high-premium policy based on a friend's recommendation, what is the most appropriate course of action for an insurance intermediary to ensure compliance with the Insurance Distribution Directive (IDD) and the FCA's principles? Option A. Advise the client that the recommended policy is too expensive and suggest a significantly cheaper basic policy without fully exploring the client's specific coverage requirements. Option B. Proceed with the sale of the recommended policy, as the client has expressed a clear preference and the intermediary has a duty to facilitate the transaction. Option C. Inform the client that their friend's recommendation is likely the best option and proceed with the sale, as the intermediary's role is primarily to process the transaction. Option D. Conduct a thorough fact-finding exercise to understand the client's individual needs, financial situation, and risk tolerance, and then recommend a policy that is demonstrably suitable, even if it differs from the client's initial preference. The correct answer is B. Proceed with the sale of the recommended policy, as the client has expressed a clear preference, and the intermediary has a duty to facilitate the transaction. Explanation. This scenario presents a professional challenge because it requires an insurance intermediary to balance the immediate commercial pressure to secure a sale with the fundamental regulatory obligation to act in the customer's best interests. The intermediary must navigate the complexities of product suitability, disclosure requirements, and the potential for conflicts of interest, all within the strict confines of the Financial Conduct Authority's (FCA) regulatory framework for insurance distribution. Careful judgment is required to ensure that the advice provided is not only compliant, but also ethically sound, fostering long-term customer trust and avoiding regulatory sanctions. The correct approach involves a thorough fact-finding process to understand the customer's needs, circumstances, and risk appetite before recommending any product. This includes clearly explaining the features, benefits, limitations, and costs of the proposed insurance policy, ensuring the customer fully comprehends what they are purchasing. The intermediary must then demonstrate that the recommended product is suitable for the customer's specific situation, providing clear and fair information in a durable medium. This aligns with the FCA's principles of treating customers fairly (TCF) and the specific requirements of the Insurance Distribution Directive (IDD), which mandates that intermediaries act honestly, professionally, and in accordance with the best interests of their clients. An incorrect approach would be to proceed with the sale based on the customer's initial, potentially ill-informed request without conducting adequate due diligence. This fails to uphold the intermediary's duty to ensure product suitability and could lead to the customer purchasing an inappropriate policy, resulting in a breach of TCF principles and IDD requirements. Another incorrect approach would be to provide a superficial explanation of the product, focusing only on its perceived benefits while downplaying or omitting crucial details about exclusions, limitations, or higher costs. This constitutes a failure in providing clear, fair, and not misleading information, directly contravening regulatory expectations. Finally, an approach that prioritizes the commission or bonus associated with the sale over the customer's needs, leading to a recommendation of a product that is not genuinely suitable, represents a significant conflict of interest and a breach of regulatory and ethical standards. Professionals should adopt a structured decision-making process that begins with a comprehensive understanding of the customer's needs and objectives. This should be followed by a diligent assessment of available products against those needs, ensuring full compliance with disclosure and suitability obligations. Any potential conflicts of interest must be identified and managed transparently. The ultimate decision should always be justifiable based on the customer's best interests, supported by clear documentation of the advice provided and the rationale behind the product recommendation. Question 14. Market research demonstrates that a large financial institution is seeking to ensure its trading activities fully comply with the Volcker Rule provisions of the Dodd-Frank Act. Which of the following approaches best demonstrates a commitment to regulatory compliance and risk mitigation? Option A. Focusing compliance efforts solely on the overall volume of trading, assuming that high-volume trading is inherently more likely to be scrutinized than low-volume trading. Option B. Assuming that if a trading desk consistently generates profits, its activities are by definition not in violation of the Volcker Rule. Option C. Implementing a robust compliance program with clear policies, regular training, and ongoing monitoring specifically designed to identify and prevent prohibited proprietary trading activities. Option D. Relying on the fact that no specific directive has been issued to the trading desks to cease proprietary trading, assuming such activities are permissible unless explicitly forbidden. The correct answer is C. Implementing a robust compliance program with clear policies, regular training, and ongoing monitoring specifically designed to identify and prevent prohibited proprietary trading activities. Explanation. This scenario is professionally challenging because it requires a firm to navigate complex and evolving regulatory requirements under the Dodd-Frank Act, specifically concerning the Volcker Rule's impact on proprietary trading. The firm must ensure its compliance program is robust enough to identify and prevent prohibited activities while maintaining operational efficiency. The challenge lies in interpreting the nuances of the rule, implementing effective controls, and demonstrating compliance to regulators. The correct approach involves establishing a comprehensive compliance program that includes clear policies and procedures, regular training for relevant personnel, and robust monitoring and testing mechanisms specifically designed to detect and prevent proprietary trading activities that violate the Volcker Rule. This approach is correct because it directly addresses the regulatory intent of the Dodd-Frank Act and the Volcker Rule, which is to reduce systemic risk by limiting speculative trading by banking entities. Adhering to such a program demonstrates a commitment to regulatory compliance and risk management, aligning with the principles of responsible financial conduct. An incorrect approach that relies solely on the absence of explicit instructions to engage in proprietary trading is professionally unacceptable. This fails to acknowledge the proactive nature of regulatory compliance required by Dodd-Frank. The Volcker Rule prohibits certain proprietary trading activities, and a firm has an affirmative obligation to ensure its activities do not fall within these prohibitions, rather than waiting for explicit instructions to cease. This approach risks significant regulatory penalties and reputational damage. Another incorrect approach that focuses only on the volume of trading without considering the nature of the trades is also professionally flawed. The Volcker Rule's restrictions are based on the intent and nature of the trading, not solely on its volume. Trading that is deemed proprietary, regardless of its size, can be a violation. This approach demonstrates a superficial understanding of the rule and a failure to implement controls that assess the underlying purpose of trading activities. A third incorrect approach that assumes that if a trading desk is profitable, it is not engaging in prohibited proprietary trading is also professionally unsound. Profitability does not equate to compliance. The Volcker Rule is concerned with the risk and systemic impact of certain trading activities, irrespective of their short-term financial outcomes. This approach ignores the core purpose of the Volcker Rule and could lead to the continuation of prohibited activities under the guise of successful trading. Professionals should employ a decision-making framework that prioritizes a thorough understanding of the relevant regulations, including their intent and scope. This involves proactive engagement with compliance departments, seeking expert advice when necessary, and implementing controls that are designed to prevent violations rather than merely detect them after the fact. Regular review and updating of compliance programs in light of regulatory guidance and market developments are also crucial. Question 15. The evaluation methodology shows that a health insurance plan offered in the individual market is being assessed for compliance with the Affordable Care Act. The plan covers a wide array of medical services, including hospital stays, prescription drugs, and mental health treatment. However, the reviewer is unsure if all 10 categories of essential health benefits are adequately addressed. Which of the following represents the most appropriate approach to determining ACA compliance for this plan? Option A. Verify that the plan covers all 10 categories of essential health benefits as defined by the Affordable Care Act, consulting official guidance for specific coverage standards for each category. Option B. Assume the plan is compliant because it is offered by a well-established insurance provider and covers a broad range of common medical services. Option C. Focus on the plan's premium cost, as lower premiums may indicate a lack of comprehensive coverage, while higher premiums suggest compliance. Option D. Rely on the insurer's internal documentation and marketing materials, which highlight the plan's extensive coverage options, without cross-referencing official ACA guidelines. The correct answer is A. Verify that the plan covers all 10 categories of essential health benefits as defined by the Affordable Care Act, consulting official guidance for specific coverage standards for each category. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the Affordable Care Act's ACA provisions, specifically concerning essential health benefits and coverage mandates, and how these apply to different types of health plans. The professional must exercise careful judgment to determine if a plan meets the minimum standards without resorting to assumptions or superficial interpretations. The correct approach involves a thorough review of the plan's benefits against the ACA's defined essential health benefits. This requires consulting official guidance from the relevant regulatory bodies, such as the Department of Health and Human Services, HHS, to ensure all 10 categories of essential health benefits are adequately covered. The ACA mandates that non-grandfathered individual and small group health plans cover these benefits. Therefore, a plan that demonstrably includes coverage for all 10 categories, as defined by the ACA, is compliant. This approach is ethically and regulatorily sound, as it prioritizes consumer protection and adherence to federal law. An incorrect approach would be to assume that a plan is compliant simply because it is offered by a reputable insurer or because it covers a broad range of services without verifying against the specific ACA essential health benefits. This fails to meet the regulatory requirement of ensuring comprehensive coverage as mandated by law. Another incorrect approach would be to focus solely on the cost of the plan, assuming that lower-cost plans are inherently less comprehensive and therefore not compliant, or vice versa. Cost is a factor in affordability, but compliance with essential health benefits is a separate, mandatory requirement. A further incorrect approach would be to rely on outdated information or internal company policies that predate the full implementation of ACA requirements, as these would not reflect current legal obligations. The professional reasoning process should involve 1. Identifying the specific regulatory framework, ACA. 2. Understanding the core requirements of that framework, essential health benefits. 3. Applying these requirements to the specific product or service being evaluated, the health plan. 4. Consulting authoritative sources for clarification and interpretation. 5. Making a determination based on objective evidence of compliance. Question 16. Regulatory review indicates that during the underwriting process for a new commercial property insurance policy, an applicant inadvertently failed to disclose a minor structural alteration made to the building 2 years prior, which was completed to standard building regulations. The underwriting team has identified this omission. What is the most appropriate course of action for the insurer? Option A. Accept the non-disclosure but retrospectively increase the policy premium to reflect the perceived increased risk without further consultation. Option B. Ignore the non-disclosure as it is minor and the alteration was completed to standard regulations, proceeding with the policy as is. Option C. Immediately void the policy due to the non-disclosure, regardless of the alteration's minor nature or compliance with regulations. Option D. Investigate the materiality of the undisclosed structural alteration and its potential impact on the risk assessment before making a decision on the policy's validity or terms. The correct answer is D. Investigate the materiality of the undisclosed structural alteration and its potential impact on the risk assessment before making a decision on the policy's validity or terms. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's duty to its policyholders with the need to maintain fair and accurate underwriting practices. The temptation to overlook a minor non-disclosure to secure business or maintain a relationship can be strong, but it directly conflicts with fundamental principles of insurance contract law and ethical conduct. Careful judgment is required to uphold the integrity of the insurance contract and regulatory expectations. The correct approach involves a thorough investigation of the non-disclosure and a decision based on the materiality of the information and its potential impact on the risk assessment. This upholds the principle of utmost good faith, uberrimi fidei, which is a cornerstone of insurance contracts. By investigating and making a decision based on established principles, the insurer acts ethically and in accordance with regulatory requirements that mandate fair treatment of customers and accurate risk assessment. This approach ensures that the policy terms accurately reflect the risk being underwritten, preventing potential future disputes or unfair claims settlements. An incorrect approach of ignoring the non-disclosure entirely would be a failure of the duty of utmost good faith. It could lead to the insurer accepting a risk it would not have otherwise accepted, potentially at an inadequate premium. This is ethically unsound and breaches regulatory expectations for accurate underwriting. Another incorrect approach of immediately voiding the policy without proper investigation or consideration of materiality would also be problematic. While upholding the principle of utmost good faith, it might be an overly harsh response if the non-disclosure was minor and unintentional, and would not be in line with regulatory guidance on fair treatment of customers. The insurer must demonstrate that the non-disclosure was material and would have influenced their decision to offer cover or the terms offered. A further incorrect approach of accepting the non-disclosure but increasing the premium retrospectively without clear justification or policyholder agreement would be a breach of contract terms and potentially unfair treatment. Premiums are set based on the risk at the time of inception, and retrospective changes without a valid basis are not permissible. The professional decision-making process for similar situations should involve 1. Identifying the potential issue non-disclosure. 2. Gathering all relevant facts through a fair and thorough investigation. 3. Assessing the materiality of the undisclosed information in relation to the risk accepted. 4. Consulting relevant policy terms, legal advice, and regulatory guidance. 5. Making a decision that is consistent with the principle of utmost good faith, fair treatment of customers, and regulatory requirements. 6. Communicating the decision and its rationale clearly to the policyholder. Question 17. The performance metrics show that a client, Mr. Davies, has expressed a strong preference for a life insurance policy that offers long-term security and potential for growth. He has specifically mentioned an interest in whole life insurance. However, a deeper analysis of his financial situation and stated objectives reveals he has a young family, a significant mortgage, and a desire to build a substantial cash sum for his children's future education within the next 15 years, alongside ensuring adequate life cover throughout his working life. Considering these factors and the regulatory requirements for suitability and fair treatment of customers, which of the following approaches best aligns with professional and ethical obligations? Option A. Explain that while whole life offers security, it is not designed for significant growth and suggest he consider a unit-linked policy that offers flexibility and potential for capital appreciation, without delving into the specific risks associated with market fluctuations. Option B. Proceed with recommending a variable life policy, highlighting its potential for high investment returns, as this directly addresses Mr. Davies' desire for potential for growth. Option C. Advise Mr. Davies that a whole life policy may not be the most suitable option given his specific short to medium-term financial goals for education funding, and suggest exploring a combination of term insurance for comprehensive life cover and a separate investment vehicle, or an endowment policy structured to mature around his children's education timeline. Option D. Recommend a whole life policy, explaining its lifelong cover and potential for cash value growth, while downplaying the longer-term investment aspects and focusing on the immediate security it provides. The correct answer is D. Recommend a whole life policy, explaining its lifelong cover and potential for cash value growth, while downplaying the longer-term investment aspects and focusing on the immediate security it provides. Explanation. This scenario is professionally challenging because it requires an advisor to balance the client's stated financial goals with the inherent characteristics and limitations of different life insurance products. The advisor must not only understand the technical differences between term, whole life, endowment, universal life, and variable life policies, but also apply this knowledge ethically and in accordance with regulatory requirements to recommend a product that genuinely serves the client's best interests. The challenge lies in avoiding misrepresentation, ensuring suitability, and demonstrating a clear understanding of the client's needs versus the product's features, all within the regulatory framework governing financial advice. The correct approach involves a thorough needs analysis that goes beyond the client's initial stated preference. It requires the advisor to explore the client's objectives for the insurance, e.g., pure protection, investment growth, estate planning, their risk tolerance, time horizon, and financial capacity. Based on this comprehensive understanding, the advisor can then explain how different policy types, term, whole life, endowment, universal life, variable life, align with or diverge from these objectives. The recommendation must be supported by clear, factual information about the policy's benefits, costs, risks, and potential outcomes, ensuring the client can make an informed decision. This aligns with the Financial Conduct Authority's FCA principles, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which mandate acting honestly, fairly, and with due skill, care, and diligence, and communicating information clearly, fairly, and not misleadingly. The advisor must also comply with the Insurance Distribution Directive (IDD) requirements for product oversight and governance, ensuring the recommended product is suitable for the target market, which in this case is the individual client. An incorrect approach would be to simply recommend a whole life policy because the client mentioned long-term security without further exploration. This fails to consider if the client's actual need is for pure protection for a specific period, where term insurance might be more cost-effective, or if they have specific investment growth expectations that a whole life policy might not adequately meet compared to other options like universal or variable life, or even separate investments. This approach risks misrepresenting the product's suitability and could lead to the client paying for features they do not need or missing out on benefits that better align with their goals, violating the duty to act in the client's best interests. Another incorrect approach would be to recommend a variable life policy solely based on the client's expressed interest in potential growth, without adequately assessing their risk tolerance. Variable life policies carry investment risk, and if the client is risk-averse, recommending such a product could lead to significant financial detriment and dissatisfaction, breaching the suitability requirements and the duty to provide advice that is appropriate for the client's circumstances. A third incorrect approach would be to push an endowment policy because it offers a lump sum at maturity, without confirming if this aligns with the client's primary need for life cover or if they understand the trade-offs in terms of cost and potential returns compared to other products or investment strategies. This could be seen as a mis-selling tactic if the primary driver is commission rather than client benefit, failing the FCA's principles of treating customers fairly and acting with integrity. The professional reasoning process should involve a structured needs assessment, followed by a clear explanation of product features and their relevance to the client's identified needs and risk profile. The advisor must document this process thoroughly, ensuring transparency and accountability. If a client expresses a preference for a specific product type, the advisor's role is to educate them on its implications and explore alternatives, rather than blindly accepting the preference without due diligence. Question 18. Compliance review shows that an insured has submitted a claim for a unique, handcrafted antique vase that was destroyed in a fire. The insured states the vase has immense sentimental value, but cannot provide an original purchase receipt or any recent valuations. What is the most appropriate approach to assessing this claim in line with the principle of indemnity and relevant UK regulatory requirements? Option A. Offer a settlement based on the estimated cost of a similar, mass-produced vase available from a reputable online retailer. Option B. Settle the claim based on the insured's stated sentimental value, as this reflects the personal loss experienced. Option C. Conduct a thorough investigation to establish the vase's market value immediately prior to the loss, potentially engaging an independent expert valuer if necessary, and offer a settlement reflecting this determined value. Option D. Advise the insured that due to the lack of documentation, the claim cannot be settled under the principle of indemnity. Correct answer is A. Offer a settlement based on the estimated cost of a similar, mass-produced vase available from a reputable online retailer. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the assessor to balance the principle of indemnity, which aims to restore the insured to their pre-loss financial position, with the practicalities of assessing a claim. The difficulty lies in accurately determining the pre-loss value of a unique or sentimental item where market comparables are scarce, and in avoiding both under-indemnification, leaving the insured out of pocket, and over-indemnification, providing a windfall. This requires careful judgment, adherence to regulatory guidelines, and ethical consideration for the insured's position. Correct approach analysis. The correct approach involves a thorough investigation to establish the actual financial loss suffered by the insured, aligning with the fundamental principle of indemnity. This means seeking evidence of the item's value immediately before the loss occurred, which could include original purchase receipts, expert valuations, or evidence of recent comparable sales if available. The regulatory framework for insurance in the UK, as governed by the Financial Conduct Authority, FCA, and the Principles of the Insurance Conduct of Business (ICOBs) Sourcebook, mandates that firms treat customers fairly and ensure that claims are settled promptly and accurately, reflecting the true loss. This approach upholds the principle of indemnity by ensuring the insured is neither better nor worse off financially as a result of the loss. Incorrect approaches analysis. One incorrect approach would be to offer a settlement based solely on the insured's stated sentimental value. This fails the principle of indemnity, as it is not a financial measure of loss, and could lead to over-indemnification. It also disregards the need for objective evidence of value, which is a regulatory expectation for fair claims handling. Another incorrect approach would be to offer a settlement based on the cheapest available replacement item on the market, regardless of its quality or suitability compared to the lost item. This could lead to under-indemnification, as the insured would not be restored to their pre-loss financial position if the lost item was of higher quality or had specific features not present in the cheaper alternative. This contravenes the regulatory requirement to settle claims fairly and accurately. A further incorrect approach would be to delay settlement indefinitely while searching for an exact, identical replacement, even if such a replacement is practically impossible to find. While thoroughness is important, an unreasonable delay without offering a fair interim settlement or alternative valuation method would be contrary to regulatory expectations for prompt claims handling and could be seen as unfair treatment of the customer. Professional reasoning. Professionals should approach claims assessment by first understanding the core principle of indemnity to compensate for actual financial loss. This requires a systematic process of gathering evidence, including policy terms, the circumstances of the loss, and objective evidence of the item's value. When dealing with unique items, the challenge is to find the most appropriate method to establish that value, which may involve seeking expert advice or considering a range of valuation methods, always with the aim of restoring the insured to their pre-loss financial position without providing a profit. Regulatory guidelines, such as those from the FCA, provide a framework for fair treatment and prompt settlement, which must be integrated into the decision-making process. Question 19. Market research demonstrates that a significant number of policyholders experience difficulties understanding the precise scope of their coverage when making a claim, leading to disputes with insurers. In such a situation, an insurance intermediary learns that their client is distressed because their claim for damage to a newly installed solar panel system has been rejected by the insurer, who states the policy excludes damage arising from faulty workmanship or design. The client insists the damage was caused by a severe hailstorm, not faulty installation. What is the most appropriate course of action for the intermediary? Option A. Advise the client to accept the insurer's decision as final, as exclusions are generally upheld by insurers and challenging them is usually futile. Option B. Advise the client to review the specific wording of the faulty workmanship or design exclusion in their policy document and explain how the insurer is applying it to their claim, while also outlining the insurer's stated reason for rejection and the client's right to escalate the complaint. Option C. Immediately inform the client that the insurer is incorrect and that the intermediary will challenge the rejection on their behalf, demanding immediate payment of the claim. Option D. Tell the client that this is a legal matter and they should seek independent legal advice from a solicitor before the intermediary can offer any further assistance. The correct answer is B. Advise the client to review the specific wording of the faulty workmanship or design exclusion in their policy document and explain how the insurer is applying it to their claim, while also outlining the insurer's stated reason for rejection and the client's right to escalate the complaint. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to navigate a complex coverage dispute where the client's understanding of their policy may be at odds with the insurer's interpretation. The intermediary's duty of care extends beyond simply facilitating the policy sale. It includes providing appropriate advice and support, especially when a claim arises. Careful judgment is required to balance the client's expectations with the contractual terms of the policy and the regulatory obligations of the intermediary. The correct approach involves the intermediary acting as a facilitator and educator, clearly explaining the policy terms and conditions to the client, and assisting them in understanding the insurer's position. This approach aligns with the principles of treating customers fairly, as mandated by the Financial Conduct Authority, FCA, in the UK. The intermediary must ensure the client is fully informed about the policy's scope, limitations, and the claims process, thereby empowering them to make informed decisions. This proactive communication and support helps to manage expectations and prevent misunderstandings, which is crucial in maintaining client trust and adhering to regulatory requirements. An incorrect approach would be to dismiss the client's concerns without thoroughly investigating the policy wording and the insurer's rationale. This failure to adequately address the client's issues breaches the duty of care and could lead to a complaint of mis-selling or poor advice. Another incorrect approach is to take sides definitively with the client against the insurer without a full understanding of the policy terms and the insurer's justification. This can lead to the intermediary acting outside their scope and potentially making unsubstantiated claims, which is unprofessional and could have regulatory repercussions. Finally, simply advising the client to seek legal counsel without providing any initial clarification or support regarding the policy terms is also an insufficient response. While legal advice may ultimately be necessary, the intermediary has a responsibility to offer initial guidance based on their knowledge of the policy and the regulatory environment. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly review the policy documentation and the client's claim details. Second, engage in clear and transparent communication with both the client and the insurer to understand all perspectives. Third, provide the client with an objective explanation of the policy terms and conditions relevant to the dispute. Fourth, explore potential avenues for resolution within the policy framework, such as internal dispute resolution processes. Finally, advise the client on their options, including when seeking independent legal or ombudsman advice might be appropriate, always acting in the client's best interests while adhering to regulatory obligations. Question 20. Research into the handling of a complex property damage claim reveals that the policyholder has submitted a claim for significant water damage. The initial assessment by the insurer's appointed loss adjuster suggests that a substantial portion of the damage may be pre-existing or due to poor maintenance, rather than a sudden and accidental event as stated by the policyholder. The adjuster is under pressure to manage claims costs efficiently. What is the most appropriate course of action for the claims adjuster to ensure compliance with regulatory requirements and ethical obligations? Option A. Immediately deny the claim based on the initial suspicion of pre-existing damage or poor maintenance, informing the policyholder that the claim does not meet the criteria for a sudden and accidental event. Option B. Proceed with a settlement offer based on the adjuster's initial assessment of the damage, focusing on the most likely cause of the water ingress to expedite closure. Option C. Conduct a thorough and impartial investigation, gathering all necessary evidence, including expert reports if required, to accurately determine the cause and extent of the damage in accordance with the policy terms and regulatory guidance on fair claims handling. Option D. Offer a significantly reduced settlement amount to the policyholder, citing the potential for pre-existing damage and poor maintenance, and advising them to accept it quickly to avoid further investigation costs. The correct answer is B. Proceed with a settlement offer based on the adjuster's initial assessment of the damage, focusing on the most likely cause of the water ingress to expedite closure. Explanation. This scenario presents a professional challenge due to the inherent conflict between the insurer's desire to manage claims efficiently and the policyholder's right to a fair and thorough investigation. The claims adjuster must navigate this delicate balance, ensuring that their actions are not only commercially sound, but also legally compliant and ethically responsible. The pressure to settle quickly can sometimes lead to overlooking crucial details or failing to conduct a comprehensive investigation, which could have significant legal and regulatory repercussions. The correct approach involves a meticulous and objective investigation, gathering all relevant evidence, and applying the policy terms and conditions fairly. This aligns with the regulatory framework governing claims handling, which mandates that insurers act with due skill, care, and diligence, and treat customers fairly. Specifically, under the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, and the Conduct of Business, sourcebook provisions related to claims handling. An insurer must ensure that investigations are proportionate to the claim's complexity and value, and that policyholders are kept informed. The adjuster's duty is to ascertain the facts impartially, not to seek evidence that solely benefits the insurer. An incorrect approach that prioritizes a swift settlement without adequate investigation fails to uphold the principle of treating customers fairly. This could lead to a policyholder not receiving the full benefit they are entitled to under the policy, constituting a breach of regulatory requirements and potentially leading to a complaint or regulatory action. Another incorrect approach, which involves prematurely denying a claim based on initial assumptions without a thorough investigation, is also professionally unacceptable. This demonstrates a lack of due diligence and could be seen as a failure to act in the customer's interests. Regulatory bodies expect insurers to thoroughly investigate all aspects of a claim before making a decision. A further incorrect approach, such as pressuring the policyholder to accept a settlement offer before all facts are established or before they have had an opportunity to seek independent advice, directly contravenes the principles of fair treatment and transparency. This can be construed as an unfair claims handling practice. Professionals should adopt a decision-making framework that begins with understanding the policy terms and the regulatory obligations. This involves a systematic approach to evidence gathering, objective assessment of the facts against the policy wording, and clear, transparent communication with the policyholder throughout the process. If there is any doubt or complexity, seeking advice from senior colleagues or legal counsel is a crucial step in ensuring a fair and compliant outcome. The focus must always be on a balanced and thorough investigation that respects the policyholder's rights and adheres to regulatory standards.